Welcome to the AICA conference in New York City. I'm Jane King, and with me is Michael Testa, the CFO of Trinity Capital. And you are a BDC. So I've been talking to so many people who invest in them. Explain your company, what you do, and how you're structured.
Sure. Thanks, Jane. Trinity Capital, we're internally managed BDC. So we're headquartered in Phoenix, Arizona. Not a hub of finance people out in Phoenix, but that's where we're located. We're right around 100 people. We're internally managed BDC, so the structure, there's a nuance there. We are much more an operating company. We have, our investors have return and direct exposure to the funds that we deal with, our portfolio company yield, but we also own a management company, which allows us to invest third-party capital and receive fees, all to the benefit of our investors. So we don't pay, management fees and incentive fees. That our investors actually get a return from the management fees and incentive fees that we receive as a.
And you're publicly traded.
That's right. Well,
so that's how you capital raise.
That's right.
Right.
We raise capital to the debt and equity markets. We're traded on NASDAQ, TRIN. We have a couple of listed debt, TRINI, TRINL. So we can raise capital through the public markets and then deploy that to the private market. Technology-based companies, these are growth-oriented companies. They are growing at 50%, capital scarce in the private markets. So we are looking for capital that can't be banked. So these are, companies that are private. They're not bankable at this time, so they come to a private lender like us.
So I guess this is an alternative for them to raise money, to not do it through a bank.
That's right.
Okay.
Yeah.
And then, so what are you seeing? Where are some good places for you to put your money?
So we lend across 5 different verticals. So life sciences, tech lending, equipment financing. We're across the industry, you see a lot of reshoring of manufacturing lines. We do a lot of ag tech, frontier tech, so space. We see a lot of, Rocket Lab is a portfolio company of us. So a lot of testing equipment, satellite testing equipment. And then we do asset-backed lending, which is under SPV, bankruptcy, remote entities on receivable financing. And then we also do sponsor-backed PE buyout of SaaS, enterprise SaaS companies. Okay. So the technology there as well. And
interest rates have been very interesting over the past couple of years. I assume that must have a big impact on your business.
So I think that's very much a sentiment at the macro level of the movement in interest rates. The BDCs, we saw a nice, aggressive rate hikes, in a short period of time. You've seen some rate cuts. I'm not going to predict where the rates are going to go from now, but it's been a benefit for us because of the niche we play in. We have, there's kind of a limit and then a floor to what we charge. The mid-teen returns, our interest rates, we did see the base rates come down, and we have floors in all our deals. So once base rates go beyond that, we have a floor to what we charge. And we see some prepayments just on that dynamic. They may easily finance us out with, cheaper debt. But that's a benefit to us in a period that they repay. We get prepayment penalties and accelerated fees in those periods.
Yeah. Okay. Michael, thank you so much for explaining the company.
Thanks, Jan. Appreciate being here.